I'm John Erlichman. Welcome to Bloomberg Markets.
And I'm Kriti Gupta. Let's get a quick check on those markets. Take a look at the price action. Green on the screen when it comes to the S&P 500. A fast and furious rally back from the dip we saw yesterday, up 1.6%. But it's not just the stock market that's catching my eye here. You also have to look at the two-year yield, up 10 basis points, a massive jump off of that retail sales data that came in stronger than expected. At the end of the day, John, the American consumer is spending. But take a look at this. The dollar also weaker. Remember, this is really important, that correlation, that inverse correlation between the dollar and the stock market, still extremely high, which tells you when the dollar is weaker, that's incentive for some people to hop into the market. And it looks like people are taking that opportunity. We should also mention the Bloomberg Commodity Index, food prices, oil prices, even copper, metal prices, all higher on the day, John.
And Kriti, we do want to update viewers on the performance of Dow component Boeing today. Mark Crumpton was just telling us this story. Right now, Boeing shares are up close to 6% on those headlines about the China Eastern Air black box. Based on this reporting from the Wall Street Journal, that tragic crash, the implication here that it could have been intentionally nosedived by the pilot. We'll wait for more details on this one, but obviously when it comes to liability or responsibility, the market watching that closely. Also on a day where we got some headlines on China Southern, a key 737 MAX customer for Boeing in China, mentioning that more than 100 jets are no longer part of their plans, at least for now, citing some delay, uncertainty around that. So a lot to watch on Boeing. We'll keep you posted. We have to update you as well on some news about Twitter. It continues to come, and this time a scoop from our Bloomberg colleagues about the company losing 3 more senior employees, including 2 vice presidents, as staffers wait for Elon Musk's $44 billion acquisition to close. Kurt Wagner and Ed Ludlow breaking that news, and Ed joins us now with more details. Ed, what can you tell us about these staff departures?
Yeah, these 3 departures in question were senior managers, 2 vice presidents and a head of department. We're told that they left of their own volition, that they were not fired. They were given the opportunity to send a message around internally explaining their reasons for leaving. But clearly, you know, this is the latest wave of restructuring, right? 3 departures, hot off 2 very senior departures last week. And the company, from what we're hearing from insiders, is kind of in wait-and-see mode, right? They're trying to get on with business as usual, but the state of this bid by Elon Musk is not clear because of Elon Musk, because he, you know, has put it on, quote, temporary hold due to the concerns he has about the proportion of users on the platform that are bots, his assessment of that versus what the company are telling him is true.
But Ed, this follows some other layoffs within the company as well going into this. Can you speak a little bit about that part of the equation?
Yeah, so last week, at the end of last week, Kayvon, who's one of the senior vice presidents of the company, was asked to leave by CEO Parag Agrawal. He kind of tweeted that this was the case and that he was disappointed. You know, Elon Musk has been taking meetings, we now know, with Twitter leadership and discussing a number of things. You know, the main issue continues to be bots. You know, Twitter has stated in regulatory filings and reiterated in public statements that the number of bots on the platform is less than 5%, although there's a margin of error because it's fluid. And what we understand from CEO Parag Agrawal is that he met with Elon Musk 7 days ago, explained the methodology to him about how this is the case. So there's kind of 2 things happening here, right? Departures from the company, people that are like long-standing executives that have been a big part of Twitter in the last few years. At the same time that management are trying to get this deal done. And don't forget, we got the proxy as well on Tuesday morning where Twitter and Twitter's board advised shareholders that they should vote in favor of the deal as it currently stands, which is $54.20 a share.
Bloomberg's Ed Ludlow bringing us that Bloomberg scoop. We appreciate it as always. Let's pivot here and take a look at one of the major stories from this morning. U.S. retail sales data and earnings from Walmart and Home Depot indicate American consumers, well, they're still spending despite the higher prices. Poonam Goyal of Bloomberg Intelligence joins us now. Poonam, thank you as always. Should we be concerned, even though we do see some pretty big earnings beats, some pretty strong retail sales data? What's the problem here?
The problem is only inflation. You know, from a top line perspective or sales, the consumer is spending. We saw that in the retail sales number this morning, with especially the upwardly revised March estimate. We saw it also in Walmart and Home Depot earnings. There's no signs that the consumer is slowing down in any meaningful way. Home Depot, largest surprise, where they actually posted an increase. And that was most interesting to us, because we have been hearing from Wayfair and others about tougher comparisons, and just spending on home could potentially slow as we move off of peak pandemic demand, but that wasn't the case at Home Depot. So very encouraging there.
And looking at the reaction in Walmart shares today, Poonam, and the inflation realities that they are dealing for the business, are you getting a sense, as you hear from more of these retailers, that there are certain players that might easily pass on some of those higher costs, and others where obviously the low price for the consumer is a priority, where they'll try to navigate that?
Yeah, I mean, when you talk about inflation passing those price increases on that the retailers are grappling with, it's true that dollar stores, Walmarts may have a harder time passing them on because they do focus on value. But then there are retailers that I cover, including the athleisure companies like Nike, Lululemon, Adidas, where they are able to pass on those price increases because the purchase is more discretionary and there is more brand affinity that the customer can actually pay the extra 4, 5, 7% that they're going to raise by.
All right, Poonam, helpful breakdown as always. Thanks very much. Poonam Goyal of the Bloomberg Intelligence team. And let's take a deeper look at those retail numbers from both Walmart and Home Depot. Joining us with some more perspective, Joe Feldman of Telsey Advisory Group, a senior managing director there. He's got an outperform rating on shares of Walmart and Home Depot. I guess, Joe, let's start with Home Depot. We were making a reference to it there. You've got questions about what's going to happen to the housing market in a higher rate environment. What does that mean for mortgages? And yet they are signaling that they're still expecting plenty of work on homes and activity in that sector through the year.
Yeah, the demand for home improvement projects remains very high right now. And, all the data that we are getting, I know housing itself, turnover may be slowing a little bit, and there could be a little pressure in the market with the higher rates. But 95% of the homeowners out there are staying put. They are not moving. They're not turning over the home. And when that is the case, they feel that they're living in their homes longer. They feel the value of their home has gone up more. They're spending more on the home. And we've seen that through the years, and we expect that to continue. And really, that's what Home Depot saw today. I think we'll hear more about that from Lowe's tomorrow as well.
Joe, I have to ask about the international component of this, because sure, you had some pretty strong numbers from Home Depot and arguably from Walmart as well on a retroactive basis. But one of the big concerns from Walmart earnings was this idea of a stronger dollar impacting international sales. Even on the Home Depot front, volume of sales actually came down. So I have to ask, the warnings that the market is broadly worried about, the stock market sell-off, does it have any footing when you look at these earnings?
Well, I think that, from the dollar perspective, yes, it's going to have some impact on the translation of the currencies. And you definitely saw that at Walmart, to some extent at Home Depot. But what we're thinking is that the underlying constant currency sales of those businesses, meaning the business done in local currencies, was actually quite strong. And when you look at Walmart's international business, for example, their same-store sales in China and Mexico, Canada, were all up mid to high single digits. So in local markets, they're actually performing quite well. I understand the translation. I understand the issues related to that. But I think most investors really do look to the constant currency sales for a lot of these large companies that do international business.
And Joe, before we let you go, I wonder if there will be a point when that supply chain scale will benefit some of these companies, because Walmart has one of the most extensive supply chain networks around the world, depending on how long we are dealing with inflation, assuming some of the supply chain headaches get resolved.
Yeah, that was definitely something that frustrated investors today. And I think you're seeing that in the stock price move of Walmart this morning, where the supply chain definitely, we thought they were going to be able to manage through that a little bit better. It sounds like it was timing is some part of it, because the prices rise really rapidly. Surcharges for freight and transportation costs happen. And then by the time you pass that through to the consumer, there's a little bit of a lag. And so I do think that Walmart's going to be in better position to handle that, but we're going to see that, and already are seeing that from a lot of the retailers. I mean, I think we'll hear more of that from Target and from others tomorrow, that global supply chains are under a lot of pressure, and that's really impacting retail earnings right now, even with the better sales that we're seeing because of the inflation boost.
Joe Feldman of Telsey Advisory Group, we thank you as always for your insights on this very fascinating topic. Coming up, though, we'll talk with Jason Kenney, the Premier of Alberta, Canada, why he's pitching the sale of more Canadian oil to the United States. Can it really help solve the problem of soaring gas prices, though? We're going to ask him that conversation next. This is Bloomberg.
This is Bloomberg Markets. I'm John Erlichman with Kriti. Gupta, the Premier of Alberta, Canada, speaking before a U.S. Senate committee today, pitching the sale of more oil. It comes at a time of skyrocketing prices with demand outstripping supply. But can enough oil from Canada be supplied in time to really make a difference? And would the U.S. consider, for example, resurrecting Keystone XL, that pipeline? Joining us for more on all of those issues is Jason Kenney, the Premier of Alberta. Premier Kenney, thanks very much for joining us. You were with us about 3 months ago when you were in D.C. Since then, Senator Joe Manchin made a trip out to Alberta to see the energy operations. So there's a deep dialogue you've been having. Let's talk about some of the tangible things where we could see action. Today, you were talking about the amount of additional oil that could potentially come from Canada just by making a few tweaks to existing pipelines and offering oil through rail shipments. Can you elaborate on what you talked about in the Senate?
Sure. Right now, we have about 300,000 barrels a day of open, unused capacity in the North American pipeline system. And I think we will be filling that with some additional production out of Alberta this year. Secondly, if midstream companies all go ahead with some optimization programs on their pipelines, some line reversals, there's an estimate that we could potentially have about 400,000 more barrels a day of egress to the U.S. refineries. Thirdly, once the current capacity is filled, the companies can always swing to rail. We have about 200,000 barrels a day of unused rail capacity. And then finally, by the first quarter of 2024, the Trans Mountain Pipeline expansion should be operational, taking about 600,000 barrels a day from Edmonton to Vancouver, putting it on small tankers, most of which will offload at refineries in Washington State and California. Now, if you add all of that up, it could be on the outside as much as 1.5 million barrels a day over the next 2 years, but we probably won't be able to produce that much. My point is, let's be visionary about this. Let's have a North American Energy Alliance, and let's get another major pipeline done, because we've got the third largest reserves on Earth up in Alberta.
Well, you're talking about pipelines, sir, but that seems to be something that the Biden administration is very much against. And I would argue a lot of the state and local governments as well. The state of New York, for example, very vocal about trying to have a cleaner infrastructure. How are you going to convince your American counterparts that that's the answer?
Well, what I'm hearing from my American counterparts is that the number one concern of Americans right now is inflation, especially on energy, the price of gas. The president himself has said that this is a crisis that he's very focused on, and he's been pleading with OPEC generally, Saudi Arabia in particular, to produce and ship more. His administration has been trying to lift sanctions on both Venezuelan and Iranian oil exports. So our point is, instead of looking to the world's worst regimes, who are in some cases sworn enemies of the United States, like Iran and Venezuela, why not turn to your closest friend, neighbor, and ally, which already ships 62% of U.S. oil imports? That comes from Alberta, Canada.
Meanwhile, Premier, you urge senators to safeguard the Line 5 pipeline, which Michigan has tried to shut down. What happens next?
Yeah, so that is right now, there are state and federal court challenges between the pipeline company, our government, Canada, and the governor of Michigan. There's also negotiations happening because this is in violation of a 1977 pipeline treaty between Canada and the United States. But my message today is, I don't know why the Biden administration is sitting on the fence, neutral on this issue, while pleading that OPEC ship more energy, and you have a U.S. governor trying to shut down a pipeline that for 6 decades has safely delivered over 500,000 barrels a day of Canadian energy, largely to the upper Midwest, to refineries in Ohio, Pennsylvania. Detroit Airport would shut down. without the aviation fuel coming off Line 5. The Upper Michigan Peninsula would not be able to heat homes in the winter without the propane off that line. So while the U.S. is facing an energy crisis, why in the world would the U.S. government not come on side with Canada and Alberta and just tell the governor of Michigan, work with Enbridge on the new safe subterranean pipeline to replace the one that's been safely operating for 60 years?
Well, we'll watch to see where that conversation goes. Before we let you go, Premier Kenney, as Alberta's economy is rebounding right now, your leadership is on the line. We're awaiting the results tomorrow of the leadership review for your United Conservative Party. What do you think happens? Do you think you will win that?
Well, I'm optimistic. I've been all around Alberta the last couple of months since we've been able to drop all the COVID restrictions, and I'm getting overwhelming expressions of support because, you know, we've turned the corner. COVID was divisive for our party, like many communities around the world. But the worst of that, we believe, is behind us. Alberta is leading Canada in economic and job growth. Our government has kept 90% of our election commitments with a year to go, a year of economic growth. We're growing the economy, creating jobs, getting pipelines done like Line 3 and TMX, and building a stronger province. I think the majority of Alberta Conservatives want to move forward together, not go into the ditch of division. And so I'm optimistic about the outcome tomorrow.
Alberta Premier Jason Kenney, we thank you as always for your time joining us from Washington. Coming up, blocking payment. The U.S. is set to shut down Russia's ability to pay U.S. bondholders. More on what the move could mean for Moscow's odds of a default next. This is Bloomberg. This is Bloomberg Markets. I'm Kriti Gupta with John Erlichman. Bloomberg has learned the Biden administration is set to fully block Russia's ability to pay U.S. bondholders after the deadline expires next week. The move could bring Moscow closer to the brink of default. Joining us to break it all down is Bloomberg's Christine Aquino. Christine, thank you as always for joining us. Let's talk about what this actually means. $490 million of payments due by the end of June. How close are we getting to a default?
Well, Kriti, you know, for a while, we actually took a step back from that because Russia showed its ability and willingness to finally dig into those domestic dollar reserves and actually service their debt after initially attempting to pay that in rubles, which was, of course, not in line with the bond documents. But anyway, now we're taking another step closer to default because of this latest U.S. move. And really what this goes to show is that you really cannot take for granted just how close Russia can get to a default situation until we get more of a permanent resolution to the situation. I think what the U.S. is doing now is, again, upping the ante for Russia and really forcing them to, again, try and make those payments potentially or make more concessions, either with regards to bond payments specifically or the war in general, until they're willing to give them a reprieve.
And Christine, very quickly, obviously, think back to that first fear of a default in the markets as we were just figuring out what that would mean. We were making sense of it in real time. Now that people in the markets have had a time to think a little bit more about this, what are people going to be watching for closely?
Well, John, I think, you know, it's going to be a lot of that potential post-default fallout, particularly for any investors who are still invested, the specific bondholders of the bonds that are due 2 days after this deadline expires by the U.S. They have a couple of bond redemptions up or bond coupon payments that are going to be due. So we're going to be watching out for whether those bond investors do get paid or, if not, what their next steps are going to be.
Bloomberg's Christine Aquino breaking it down for us. As always, we thank you for your time. John, as I look at the markets here, the S&P 500 up 1.6%, hovering near those session highs. The dollar, though, hovering near those session lows. That inverse correlation very much a part of the conversation. And the two-year yield continues to catch my eye, 10 basis points higher. For John Erlichman, I'm Kriti Gupta. This is Bloomberg.